All right, hello there, everybody. This is Mark Weissy and Gonzalo coming here live from Maple Capital Partners. We are hoping to take you all through the multifamily market update research that we've been reading from the likes of Marcus Millichap, the National Association of Realtors, as well as S&P. These bodies, as well as many other, are among the top research that we read on a monthly and sometimes quarterly basis. And it's really important for us as multifamily investors to stay abreast of what's going on in the economy and what's going on in the multifamily market and where these institutions see the market going.
Absolutely.
So first, we're going to start off with some data. So this is kind of where we're at. I'll start with the rent growth. So for Q2, we just ended, our rent growth was 4.1%. That's a massive upside surprise here on the rent growth side, and equally so on the vacancy rate side. So where we've gone somewhere near the 5% earlier during COVID, and now closer to 3.8%. How did we get there? So we're going to talk a little bit about the economy, and then we'll delve into some of the multifamily market fundamentals that have caused this this trend to happen. So on the economic side, obviously, we're coming back slowly. As the economy recovers, we're going to be adding jobs. And so far this year, Marcus Millichap is expecting 4.6% increases in employment for the year. And that equates to 6.5 million jobs. That said, we still have a large number, in fact, historic number of job openings as per the latest LinkedIn survey. So, there are tons of people coming back into the workforce. There still remain, a good portion of people. I believe it's 3 or 4 million people on the sidelines that lost their jobs during COVID. I imagine a lot of that is coming from the leisure and hospitality sector, some of the sectors that were hardest hit. And hopefully we can, have those people come back into some of these job opportunities that are being posted.
Yeah, exactly. And perhaps it may bode well with people coming back, as the federal government is going to be ending the $300 a week enhanced federal employment benefits. So that throughout this 1 year or so of these benefits, as well as additional federal stimulus, it's really bolstered the consumer balance sheets of residential households. And that will lead into the next discussion as the prices of things have gone up, as everybody has known.
Absolutely. Yeah. So your point about consumer balance sheets being strong. I mean, I think a lot of people, and frankly, a lot of well-respected people during the quarantine and during the depths of the crisis earlier 2020, were saying that, the consumers would fall apart, that they would have mass layoffs, mass evictions, things like that. And the federal stimulus, I think, stemmed a lot of that stuff. So that's really a positive thing that held up the market there.
Absolutely. Yeah. So if I could just start this slide. So this slide here basically kind of shows the vacancy, and as everybody known, during COVID, a lot of individuals left the downtown urban core and they moved to the suburbs, and you can see that by that huge spike in vacancies of the downtown urban core. Basically, these folks kind of relocating out to the suburbs, and a lot of these office workers, things like that. But as things are starting to open back up again, and we're starting to get a reduction of this COVID craziness, that people are starting to return back to the office. Entertainment, cultural sites are opening up in downtown urban cores, therefore perhaps attracting people back to the downtown.
Absolutely. Yeah, the appeal of the downtown living is starting to come back in terms of a lot of those sites being open and young people being called, and really everybody being called back to work in a lot of cases. So we'll see how that plays out, whether or not all of the vacancies that were experienced earlier in 2020 ultimately get filled, both on the commercial side as well as the residential side in major downtowns.
Absolutely.
So, we're going to get into a lot of demographics, but the main thing to know here is millennial workers are approaching the prime home buying age, which is 33. Yet, because of everything that we've talked about during COVID and even prior to COVID, strong barriers to entry in terms of household formation still exist today. As a result of the home prices running up during COVID, 23%, a lot of people are being blocked out, who would be forming households are being blocked out from doing so, from buying homes. While low rates are continuing to drive aggressive bidding on the home buying side.
Yeah, absolutely. And folks in that age range are approaching that home buying. They're going to have a lot of competition ahead of them. I mean, there's folks that are moving into, the suburbs. the interest rates are low, and just a large percentage of people want to buy single family residence, and it's really driving up the price, therefore kind of like blocking these individuals from potentially purchasing their first home. Therefore, they need to still keep a roof over their heads. So renting will be their second alternative if the first cannot be achieved.
Absolutely. And this is something that definitely got worse during COVID, but is by no means a new trend. Home prices were going up really since '08. And I heard one statistic recently that was talking about the lack of starter homes. So, our generation, the millennials, and the generation behind us, the Gen Zers, we're buying homes much later than prior generations who did so, right out of college. And that's really a result of the fact that the starter homes are not available. Today, starter homes are virtually non-existent. Back in the '70s, upwards of 400,000, even more than that, starter homes were created per year. Whereas today, that number is closer to 60,000. So that starter home doesn't exist. Now, millennials and those who are approaching home buying age are starting to get into what they call forever homes, much larger, more amenity rich, nicer homes.
Absolutely. So this chart here basically kind of shows you the housing demand versus the demand imbalance. So we just can't build new apartment complexes fast enough. We can't build single family residence fast enough. The demand is just very high compared to what we're actually building. So on here, you can kind of see this increases obviously barriers to home ownership for people who want to buy their first home, therefore pushing them more to be renters. Everybody's heard, we are becoming a nation of renters. That's very true based on statistics such as this. Annual deliveries on a per year basis, this is basically what we're constructing on a yearly basis, is 385,000 apartment units, and the net absorption is 460,000, meaning that for all the 385,000 units that we are building, we are filling those and some. So there's quite a large delta there, as you can see.
Absolutely. And as a result of that delta, vacancy rate is continuing to compress 3.9%, and rents are continuing to go up. It's, supply and demand, macroeconomics 101 basically here. Rent has gone up 6.8% on a year-over-year basis. And as we saw in one of the earlier slides, for just the second quarter, it went up 4%.
Jump into this one, Mark. This is an interesting one.
Yeah, so this just kind of cements what we were talking about. The cost of home ownership is just so much more expensive than the cost of rentership. In this case, there's a $451 delta between the two. So, whereas maybe a renter, a potential home buyer could afford $1,500 a month, getting to $1,900, that boxes them out of home ownership. And so, it's not a surprise why we have so many people staying as renters and not able to buy their first home.
Absolutely. Thank you. And this just ties into, just some more data that thrown at you guys here, just basically stating rent growth. So there was a slight pause from 19 to 20, as everybody has known during COVID. There was a pause in rent. A lot of people have reduced rent during that time, or just did not do any increases just due to the climate we were in at that time. And now it's 21, we're back in there, and we just kind of came back to the rent growth that we've seen in the past. As seen here.
Absolutely. So now we're going to talk about multifamily specifically, and us as buyers. This is obviously the area of the market that interests us the most. And we can tell you firsthand that multifamily competition has heated up. It's only gotten more competitive. And that's really a result of the fact that there are many more buyers in this space. A lot of the buyers on the institutional side, and even smaller buyers, maybe have been focused on office or leisure hospitality before, but they saw how multifamily held up during the downturn during COVID. And as a result of that, they're being attracted into our market now. And what has that done? That's compressed cap rates, 20 basis points down to 5.1%. And that's forced the average price at which properties are trading on a unit basis to $171,000 a door. That's up 5% year over year. So all of that renewed competition, what is that doing? That's forcing buyers into increasingly smaller markets and increasingly smaller unit sizes, by the way. We've heard several anecdotes of people who are focused on 100+ units, maybe prior to 2020, maybe 2019. They were looking at larger institutional sized assets. Now they're looking at smaller, 50 to 70 unit complexes. because the yield is no longer there. They've been pushed out of that market. There's just
Absolutely.
so much interest in the space.
Yeah, investors are searching for yield. So if they have to go outside of the downtown Nashville, just due to the fact that cap rates are 4.5%, 5%, they're going to go to these 45 minutes, 1 hour local nearest tertiary markets where they can potentially see a 1 basis point bump in a cap rate that they're searching there. And why don't you go over real quick just the relationship between cap rates and value, because I think it's important to kind of make sure everybody can understand that relationship.
Absolutely. So cap rate, I always think of it as the easiest way to think about it is it's a measure of market sentiment. So the lower the cap rate, the more aggressively that market is being bid up, the more that buyers are paying per $1 of income. So really, it's inversely related to price. So as price goes up, the average cap rate goes down, and vice versa. So that's demonstrated in this graph to the right there, where as prices have climbed higher and higher, cap rates have gone lower and lower, more and more compressed returns on the investor side.
Great. And I believe this is the last slide. So us as multifamily investors, we take the long view. Our assets is we think of something, what's going to be occurring 4, 5, 6 years down the line. And this data here kind of just continues to back up kind of like our vindication as to the
investment thesis.
Yes, correct. So these are long-term assets that we are holding, and just the data backs it up, right? You have 4.6 million millennials turning 33 this year. They can't afford to buy single-family homes, so they got to put a roof over their heads, as mentioned, and they got to rent.
Yeah, and so we've got 1.9 million households, forming this year. Yet there are only 1.4 million completions expected. So that's a net shortfall, a deficit of 470,000 units just this year alone. Now, Gonzalo and I have dug into this research a bit further, and what we found is there are some studies that indicate that there's a debt of units. So meaning, over the last few years, we have not built enough housing. So that debt of housing is in the 3.5 million unit range. So that means even if we caught up to the demand for this year, that 1.9 million number that we mentioned, we would still have a shortfall of 3.5 million units. That's massive. And that's not going to reverse anytime soon.
So that's previous year's debt that we're still trying to catch up from, correct?
Absolutely. And that's the idea, is we're investing in this market because we believe that there's a supply-demand imbalance today, and that's not likely to reverse anytime soon.
Exactly. And to kind of drive it home a little bit further, there isn't enough housing being built. There isn't enough housing being built for the demand that's out there. The appetite is there. There's a huge imbalance. It's only getting worse. And this is why we love multifamily, and we buy multifamily and we hold on to it.
And not only are we focused on multifamily for this reason, but we're focused on the particular part of the multifamily asset class that is B and C assets. For that reason, today, if you were to go any major metro in the country, you would see, a lot of building going on. I guarantee that over 90% of the building that's going on would be in the A asset class range. Nice modern amenities, resort style features like pools and gyms and dog runs and all kinds of stuff like that. Whereas the B and C class product that we tend to buy, that's just not getting built today. Why? Because of some of the things that we mentioned. The input costs are too high to build that product and for developers to make sense. So we're essentially, in buying B and C product today, we're buying a product that's no longer being made.
Absolutely, absolutely, Mark. And I was just going to end it there. And thank you, folks who have stayed on and have listened. Hopefully, you guys learned a little bit more. And as we always say here at Maple Capital Partners, be kind, be charitable, and invest wisely. We'll see you on the next one.
Thanks, guys.